Good afternoon, everyone. Welcome to our post-tax reform update. Today, we are going to go through a couple items that will be of your interest. We're going to start with a little bit of an introduction. My name is George Lavanos. I'm a tax partner with our firm Sachs LLP, a leading advisory and tax accounting firm in our marketplace. And with me is Michael Benguigui.
Good afternoon, everybody. My name is Michael Benguigui. I'm a senior tax manager and also a member of Sachs Real Estate Tax Practice.
So before we get started, a couple of household items. Please have all phones on mute. If there are questions, and we encourage your questions, please provide them to us at the end of our presentation. This presentation is no way, shape, or form to be construed as tax advice. We recommend you contact your professional, or better yet, contact your Sachs #1 advisor. With that, our discussion points today will start, and we will outline the qualified business income deduction, where the differences, however, between the final regulation what were initially proposed. 163J, the business interest expense limitation, utilizing the small business exemption or electing out. Investing in qualified opportunity zones, an overview of the program and the benefits attributable to the program, and an update on centralized partnership audit regime. With that, we will start with qualified business income deduction. And Michael, let's start with a bit of a background.
Hi. Okay, so QBI. So individual taxpayers may deduct up to 20% of qualified business income from a pass-through entity. So that could be either from a partnership or S corporation. Now, that deduction is really 20% of income which is attributable to a trade or business, including real estate. That 20% deduction is allowed for trusts and estates that own an interest in the flow-through business. And that Section 199 deduction is limited, however, to trades or businesses in performing services. So an employee is not eligible for that deduction. And there is a limitation for specified service trade or businesses. Now, an SSTB is a service-oriented business, specified service trade or business. So, for example, an accounting firm or a law firm. For those specific situations, there is a limitation in terms of that deductibility of the 20% at the individual taxpayer level.
Agreed. There's also the opportunity for REIT dividend income and publicly traded partnership income.
Yeah. So how do we determine that QBI deduction, that 20% deduction? So again, it's 20% of the taxpayer's qualified business income with respect to those trades or businesses. So 20% times whatever the net trade or business income from that at the individual level, that's your initial deduction. But that deduction is really limited to the greater of the following. 50% of W-2 wages with respect to the business, or 25% of the wages with respect to the business, plus a 2.5% of the unadjusted basis immediately after acquisition. So let's parcel that down a little bit. So 50% of W-2 wages. So if the wages are lower, that QBI deduction would be limited to the lesser of that, or 25% of those W-2 wages plus a 2.5% basis component. And that's really important because in real estate, George, as you know, is limited in terms of those W-2 wages.
Agreed.
And it's really the unadjusted basis immediately after acquisition, the UBIA, which is the important component.
All right. Now, the proposed regs versus the final regs. As we go through this, we're going to look at what guidance we previously had and where we ended up with the final regulations.
Right. So let's go through some issues and see where we are now. So issue number one, does the trade or business activity of renting real estate qualify as a QBI deduction? Now, that was an initial question, and the proposed regulations kind of touched on it, and it was really on triple net lease. So triple net lease is really the situation where we asked, is it really a trade or business in certain circumstances? And the final regulations gave us some additional guidance in terms of the notice 2019-07, and did give an illustration of certain rental activities, real estate activities, which would give the individual taxpayer some benefit in terms of determining if it's trade or business or not.
And we'll go into that in further detail.
Exactly. And UBI treatment for additional step-up in basis when acquiring a partnership interest, that was something in which the proposed regulations did not give the benefit of the UBIA. So for any Section 754 election in which there was a basis step up, that was not counted as a UBIA. Under the proposed regs, the final regulations said that, yes, you do get the benefit of that UBIA to the extent that the fair market value of the underlying property is higher than the original UBIA for such property. So then that difference...
Excluding partnership redemptions.
Exactly. So it's only really 743B. So it's really when it's a partnership sale versus a partnership redemption. So special rule for renting property to a related person. And this is something that we're going to be going through a lot in QBIA context and on the interest limitation context later down the road. So the rental or licensing of a tangible or intangible property to a related trade or business is treated as a trade or business if the rental or license activity and the other trade or business are commonly controlled, i.e. 50% or more of common ownership. So that rental real estate activity, if it's rented to an operating business and there's 50% or more of common ownership overlap, then that rental activity would take on the tack of what that operating business is. And we're going to see later if that is an SSTB, there is a limitation in terms of that QBI deduction for that rental activity.
So the self-rental, in the case of an owner who self-rents from them in that trade or business, that rental activity now will be treated as qualifying for purposes of Section 199A in terms of the deduction.
Exactly, right. And if that trade or business is an SSTB, then that SSTB taint will also be tainted to that real estate activity.
Understood.
So family attribution for purposes of aggregation of various activities. And that was one of the things that the proposed regulations that throw out there, and it's a great rule when used appropriately. And so what is the family attribution? So if one has children, spouse, grandchildren, or parents, those are considered attributable in terms of the aggregation, which we're going to be talking a little more later about when the aggregation comes in. The final regulations did expand upon that rule and basically included siblings as part of that test. Failure to aggregate. Now, the proposed regulations did not address failure to aggregate. However, the final regulations did provide that if there is a failure to aggregate in year one, it does not preclude that taxpayer to aggregate in year two. Generally precludes the taxpayers from making an initial aggregation and amended return. However, there's an exception for the 2018 tax year.
Only,
yes. Treatment of code sections 1231 gains and 1231 losses. And that was an initial question that we had before the proposed regulations came out, is would that 1231 gain be counted for an additional 20% benefit? And the proposed regulations basically said if that capital gain or capital loss or 1231 gain or loss is attributable to capital, then it is not. The final regulations did modify that rule a little bit and said that first you have to net the Section 1231 gains and losses in order to determine whether the amounts will be treated as a capital gain or ordinary loss. To the extent it's a capital gain, it is not treated as QBI. To the extent it's an ordinary loss, it does count against the QBI. Property provided to a related party in which is an SSTB, and that's something we just touched on a few minutes ago. The proposed regulations mentioned that if the property is self-rented and 80% or more of that property is used along with the SSTB, so this will be in a situation where one of our clients is a doctor or a dentist and they're self-renting the property, and 80% or more of that property is used as part of that practice, and there's more than 50% of common ownership, then that rental activity would be tainted as if it were part of the dental practice. Therefore, for QBI purposes, it would be an SSTB as well.
correct.
Now, the final regulations removed that 80% rule and basically said only to the extent of that rental activity with the related party is it considered to be an SSTB. If there are ancillary rental activity, then that additional rental activity would not be considered as part of an SSTB. Incidental activity, so an SSTB, and that was something that the initial proposed regulations threw out there, that is if 5% or less of the total combined receipts between a trade or business, which is an SSTB, and a trade or business, which is not an SSTB, if only 5% consists of non-SSTB income, then the entire activity would be considered an SSTB. And the final regulations looked at that, and the Treasury looked at that, and then final regulations removed that rule due to the administrative difficulty of keeping track of such activity. So basically, you can have a situation in which you can have two activities for purposes of QBI within one trade or business. Now, what if the next issue is failure to report certain necessary information related to Section 199 Cap A? So the proposed regulations mentioned that failure to report certain necessary information, i.e. items that need to be reported in the K-1 in order to determine the Section 199 Cap A deduction. If they are omitted, it is presumed that that rental activity is zero for QBI purposes. The final regulations did not change that rule, except any omitted item may be reported in an amended return. So that's a taxpayer-friendly rule there.
Right. So, back to the finalized regs and the context and the factors that we received, Michael, some of which were very helpful, especially in outlining what constitutes a real estate trader business.
Yes, so this is something which Treasury put in the final regulations due to comments during the hearing period in terms of what is a trader business in the real estate context. Can you give us some factors, some guidance? So basically, these are factors to consider. Type of property being rented, if it's a commercial versus residential property, the number of properties rented, the day-to-day involvement of the owner, the type and significance of type of services that are being provided under the lease that the owner is required to perform, and again, how the lease is structured versus if it's a net lease versus a long-term traditional lease. Again, this is not really a bright line test, but these are factors to consider in order to determine if one of our clients, which owns multiple properties, are they really in the trader business for QBI purposes?
I think the guidance is helpful to provide to clients specific facts and circumstances.
Right. So with that, the final regulations did also, Treasury did also issue with the final regulations a notice in 2019-07, which basically provided a safe harbor in which a rental real estate enterprise may be treated as a single trader business for purposes of Section 199 Cap A if at least 250 hours of services are performed in each taxable year with respect to that enterprise. Again, this is a safe harbor. This includes services performed by owners and independent contractors. There needs to be separate books and records, separate bank accounts, and there is a contemporaneous bookkeeping requirement in terms of those hours, of cataloging those hours. But that only starts beginning in 2019 and forward. So to 2018, those contemporaneous records are not required.
Right. So adding emphasis to that, effectively, it behooves our clients to maintain some type of log to substantiate that if they're going to avail themselves of the benefit of the safe harbor, that they need to have the record keeping in order to substantiate that.
Right, contemporaneously. A portion of the property which is triple net lease is not included as part of the safe harbor. So those hours related to that triple net lease would not be included for purposes, again, for the QBI. And this notice does define what is a triple net lease, and that's really basically where the taxes and fees, insurance, and maintenance of such property are really done by the tenant. The individual or relevant pass-through entity can group multiple properties as if it were a single enterprise. So this is really beneficial in situations in which one property has a significant amount of hours and the other one does not. But again, if you want to do that grouping, the grouping is limited in terms of the type of property that's being grouped. So commercial and residential real estate may not be grouped as part of the same enterprise. So commercial property can only be grouped with another commercial property. Taxpayers will not vary from this treatment from grouping once it's elected from year to year, unless there's been a significant change in facts and circumstances.
Right. So with a lot of our clients, this safe harbor may or may not be something they'll avail themselves in the context outside the safe harbor, where a lot of our clients do have triple net leases, but substantial operations that effectively demonstrate that they do, in fact, are acting as a real estate enterprise. So the safe harbor the notice was written to a narrow audience, and in a lot of cases, under the regulations and final regulations, the safe harbor in of itself, while be applicable for a limited group of our taxpayers and clients, the regulations really add more clarity for the larger, more broader scope of owner, operator, and developers.
Yes, indeed. Now, if you are to make the safe harbor election, or if the pass-through entity is not to make it, you do have to provide certain information in order for the individual taxpayer be able to make that election on its personal return. Now, again, and this is important, and going back to what you just said, is failure to file or to elect the safe harbor does not preclude the taxpayer from establishing that is part of a rental real estate enterprise. It just means you're not electing under the safe harbor. And one of the things that must be included when making this election is that taxpayer attests under penalties of perjury. Now, renting to related parties, and this is something that we see a lot in our practice, George, and we touched upon this a few minutes ago, is we have situations in which an operating business owns the facility in which they're operating in, and there's a self-rental between those entities. And first we have to define what is the self-rental, what is the common ownership, and really that common ownership is 50% or more. So it's 50% or more. And then you got to dig through and say, wait a second, I can understand 50% or more, but what about family attribution? How do we determine family attribution? Really, family attribution under Code Section 267B would include father, mother, spouse, brothers and sisters, including half-siblings, and lineal descendants, so children and grandchildren. And if we have situations like that, then those rental activities would be part of that trade or business. And we was mentioned earlier, if that trade or business is an SSTB, that rental activity would be limited in terms of the QBI deduction.
Agreed.
The finalized regulations also did touch upon the aggregation rules. And the aggregation rules basically is something that was, again, introduced initially with the proposed regulations, and that's a situation in which a person or a group of persons, directly or indirectly through attribution, own 50% or more of the trade or business. So that could be either through an S corporation, through a partnership, and you can then take certain items reported towards the QBI deduction, for example, the W-2 wages or the UBIA, and those items could be grouped together as if the trade or businesses that are being flown through the partnership or the S corporation were one trade or business.
Certainly, analysis has to be done to determine and maximize the benefit associated with deduction and determine whether or not aggregation is beneficial.
Exactly. And that would be, and a classic example would be a legacy property which has very little UBIA. Can be combined with a newer property which has perhaps not as much taxable income due to depreciation deductions, but has a significant amount of UBIA to share with the legacy property. So that would be a situation where that taxpayer may want to aggregate those two properties in order to better utilize that UBIA for purpose of that QBI deduction. And again, that aggregation election is done at the individual level or at the relevant pass-through entity. But once it's done, it cannot be changed unless there is new facts and circumstances.
All right. So, having gone through the qualified business income deduction and an update in terms of the regulations that were finalized, we now turn our attention to the interest deduction and the limitation attributable to Internal Revenue Code 163J. With that, Michael, let's set our eyes and give everybody a little bit of a background, and then we'll get back into the details and what was provided through regulation.
Right. So I guess with the Tax Cuts and Jobs Act, the good, the QBI, and then now we got the bad, which is this interest limitation. So effectively, starting in 2018, the deduction for business interest is limited to 30% of adjusted taxable income. And we're going to go through an example to illustrate how adjusted taxable income is determined. The limitation is determined at the entity level. So a partnership which has multiple rental properties or even trades or businesses, that limitation, again, is determined at that partnership, S corporation, or corporate level. Now, to surprise to many, the limitation applies to all types of entities, including individual taxpayers. Any disallowed business interest may be carried forward indefinitely. If limited in 1 year, it may not be limited in the following year, and any disallowed carry forward interest is released. Treasury did release proposed regulations for Section 163J, and it also did release a new form that now needs to be filed, which is Form 8990. Now, Form 8990 is required in situations in which the taxpayer has determined that it is subject to the interest limitation. In situations in which that taxpayer is not subject to the interest limitation, that partnership or S corporation would not need to file the Form 8990. However, it still will need to disclose on those K-1s certain information in order for that partner or shareholder to calculate its own interest limitation and determine its own interest limitation.
All right, so let's go through an example.
So in this situation, total taxable income at the entity level is a loss of $3,200,000. We're going to add back depreciation, amortization, and interest expense. So we're going to add back $3,500,000, $300,000, and $4 million of interest expense. Our adjusted taxable income is $4,600,000. The interest is limited to $1,380,000, which is 30% of that ATI number. So now we know what ATI is. So our current year business interest deduction at this entity level is $1,380,000, and any excess interest, in this case $2,620,000, is disallowed for the current year. Now, we want everybody to be aware of, our audience to be aware of, that this is the rule effective until January 1st, 2022. So adjusted taxable income is roughly equivalent to EBITDA, earnings before interest, tax, depreciation, amortization. However, for tax years beginning on or after January 1st, 2022, ATI will be roughly EBIT. Depreciation, amortization will no longer be added back to calculate the ATI. So using the same example we just discussed previously, our disallowed business interest expense is $3,760,000, and the only $240,000 would be allowed as an interest deduction out of $4 million.
All right. So, and as much as we went through some of the numbers, there are some things that we need to point out to everybody. The small business exemption, and we're going to go through an example, and we need to alert everybody to what constitutes tax shelter for 163J purposes. And then we're going to touch on the election to the extent it's advantageous for our real estate owner-operators to consider. With that, Michael, let's get into an example.
So the 163J limitation applies to all taxpayers, but there is, as you mentioned, there is a limitation for small businesses. So small businesses is when the three tax year average gross receipts is $25 million or less, adjusted for inflation. So if you have a partnership and it has the following gross receipts, so let's take 2018 as the year in which we're analyzing the gross receipts, and if you look through our example one, the average is less than $25 million. So if in that situation, that partnership would not be limited to the 163J deduction limitation. But going through the next year, you'll see that that in 2019 it would be subject to the interest limitation, because the average receipts is above the $25 million. And in 2020, it goes back and it is not limited.
Right. So what we want to sensitize here and demonstrate is what the impact is to the interest expense carry forward.
Exactly. First, we want to show how the test is done and how the treatment of a disallowed interest from 1 year could then be released in the following year. So in 2020, whatever was limited in 2019, that interest being limited would now be fully deductible in 2020.
All right. So let's go into what constitutes gross receipts for this test.
Right. So gross receipts is really almost all types of receipts, and it's really receipts properly recognized under the taxpayer's accounting method. Gross receipts can be reduced by returns and allowances. Does include interest income, dividend income, rental income, royalties and annuities. So it's all encompassing. Note that for capital gains in Section 1231 gains, it's really the net amount, so not the gross receipt amount. Now, note that any capital losses or 1231 losses do not help there and do not reduce the gross receipts.
All right. So as we indicated earlier, under 163J, the definition of a tax shelter is not the old definition of a tax shelter.
Yeah.
As a result of that, Michael, let's get into what happens, what constitutes a tax shelter, and what's the impact to us by virtue of being, quote unquote, deemed to be a tax shelter.
So this caught a lot of people by surprise, because a tax shelter really is any partnership or S corporation allocates in any year more than 35% losses to investors, which are limited investors.
So let's stop there for a minute. We acquire a property, we do a cost segregation study, we have a partner in a partnership that has a greater than 35% interest. By virtue of the depreciation alone, that in partner will then be, that partnership, because the allocation of a loss to a greater than 35% partner is now deemed to be a tax shelter for purposes of 163J.
Yes, so that caught a lot of people by surprise. And really, a limited investor is really one that just does not actively participate in management. That could be, and it's basically a lot of the partners in these syndicated deals or even non-syndicated deals in which a lot of our clients are putting together with friends and family. So again, this is something that needs to be considered in terms of that $25 million gross receipts test.
The ASCP and other organizations have responded to Treasury with their comments. Hopefully, we'll see some guidance, shortly.
Yeah. Since properties are held through multiple flow-through entities, in the real estate context, we need to look through, for the purpose of that $25 million gross receipts, we need to aggregate the receipts amongst separate entities as if it were part of one single entity. And the aggregation rules looks into the relationship between the entities in the following manner: parent-subsidiary relationship, brother and sister relationship. And in those contexts in which the taxpayers have those relationships, the receipts would be considered as if it were part of one entity.
Right. So in essence, we have to look behind the curtain to see what the wizard has in terms of other ownership entities that may impact this attribution analysis.
Right. So a parent-subsidiary relationship would be in which the parent has 50% or more ownership of the subsidiary, and that, for this purpose, this could be a corporation or which is the parent, or an individual, a partnership, or trust. The brother-sister relationship is really in which 5 or fewer individuals, including estates and trusts, own more than 50% of the combined power, voting power, or ownership of the various different entities.
Right. So unlike qualified business income deduction, here the test is more than 50%,
Exactly.
5 or fewer partners, whereas QBI it's 50%
or more. Right. In this situation, again, that more than 50% has to be in which 5 or fewer persons have that ownership. And there are family attribution rules that need to be considered. So let's go through an example of the brother and sister relationship. So partnerships 1 LLC, 2 LLC, and 3 LLC each own a rental building. And these partnerships are owned by Ben, Paul, and Jen. All three are unrelated individuals, and they have the following ownership of these partnerships. Capital and profits are the same. Ben owns 33% of building 1, Paul gets the same, and Jen the same. So that partnership is owned 1/3 by each one of those partners. Partnership 2 is owned 10% by Ben, 40% by Paul, 50% by Jen. And building 3 is owned by Ben 50%, Paul 30%, and Jen 15%. Now we're going to look through and see if that 5 or fewer test is met. Now, since we only got 3 individuals, each one of these properties are owned obviously by fewer than 5 and greater than 50%. But then we're going to look through and see if there is common ownership between these 3 in terms of all 3 properties, and there is. And we look at the lowest value of ownership. So Ben, in this situation, owns 10% of combined or overlap ownership of all 3 buildings. Paul has a 30% interest, and Jen has 15%. So together, they own at least 55% of all 3 of these partnerships, and therefore, for the purpose of that $25 million gross receipts test, we have to include all gross receipts from these 3 entities as if it were one entity for purposes of that test.
All right, Michael, and I think that really clarifies some of the, additional analysis we need to do to determine adequately that we are, in fact, taking advantage of the small business exemption in the right context.
Right, and with the bad, the Tax Cuts and Jobs Act did throw out this option for the real estate industry and certain other industries, which basically you can elect out of this limitation. So in the real estate industry, the election can be made in order for the interest deduction not to be limited. The election is made at the partnership or corporate level, and once it's done, it's irrevocable. And if a partnership or that entity or that flow-through entity holds multiple properties, the election is done for each property, and it's not an all-inclusive election. Right.
Again, let's emphasize that this is, in fact, an irrevocable election. An analysis has to be done to determine what's more advantageous for a given real estate owner, operator, developer in context of determining whether the election is something to avail themselves of and at what price.
Agreed, and there is a price for this. And the price is really that once a taxpayer, that flow-through entity or that corporate entity or that individual elects out, it does have to now convert its depreciable life of its assets from general depreciation to the alternative depreciation system. And then that could be costly. So as you can see from a commercial, if the property that's being held is a commercial property, that means that the property is now depreciated from 39 years to 40 years. But the real cost is really when it's residential properties acquired before 2018. In those circumstances, the property must be depreciated from 27.5 to 40 years.
So,
And that's a significant cost that we've done through analysis for several of our clients.
agreed. And it's not just the, the context of this year and the impact it's going to have on reduced depreciation. It's going to have a significant impact to the extent of of not being able to avail themselves of future bonus depreciation.
That's right. So going forward, that trade or business, that property which elected out, would no longer be eligible to elect bonus depreciation. However, it does not have to recapture any bonus depreciation that's taken in the past. And again, this option is available to the real estate industry, but there is a catch. And as we notice here with our clients, a lot of our clients, the properties, the operating businesses are rented to entities in which they own their property. So we have a situation in which an operating business, could be a manufacturer or a construction contractor, leases the building to itself, in which there is more than 50% common ownership. And if the building is leased, at least 80% of that building is leased in that common ownership between the operating business and the rental activity, then this election would not be available to them to elect out of that interest limitation. That's really the trap in the unwary for those circumstances in which that operating business self-rents. And again, common ownership is determined based on the related party rules that we discussed earlier.
Right, more than 50%.
More than 50%.
All right, Michael, having gone through qualified business income, having gone through the business interest expense limitation, and now something that is getting a lot of press, and certainly there's things we want to outline in terms of qualified opportunity zones. So with that, let's start this particular segment. Right.
So I guess with the good, we started about QBI, the bad, 30% limitation, and we're back at the good. So the new tax law did throw in there the concept of investing in the qualified opportunity zone, and really that's to encourage economic investment in distressed communities. There's over 8,000 census tracts in the country which are designated as opportunity zones in all 50 states. And if you have a property and you're trying to determine if that property is located in the opportunity zone, we do have in our website a link in which you can open up, put the property address, and they'll tell you if that property is or is not in the zone. And just to give a little bit of a background, once a taxpayer, once one of our clients or any individual determines that they want to invest in a qualified opportunity zone, they need to invest into a qualified opportunity fund. So they cannot have a direct investment into the zone, into the property itself. It must be held through a qualified opportunity fund. And really, a qualified opportunity fund is essentially a corporation or a partnership. So the first incentive, again, there are incentives in rolling over in investing in opportunity zone, and we're going to go through the three major incentives. So the first incentive is you get to defer your previous capital gain. You have 180 days to roll over the capital gain proceeds.
Right. So the capital gain can be short-term or long-term capital gain.
That's right.
And it's the gain has no relationship to the proceeds.
Right, and on top of that, there's no cash tracing to the original state of investment. So it could be from cash from a different account, not sourced to that gain. And if that gain is from a partnership interest, the 180 days starts at the end of the calendar year of that partnership. So most calendar year partnerships are 12/31/2018. So effectively, you have until June 30th, 2019 to roll over that gain. The gain is deferred to the in which the interest is held by qualified, in which the taxpayer holds the interest in the qualified fund, or December 31st, 2026. So really, this deferral is only going to be out there until December 31st, 2026. Once 2026 hits, that original gain is taxed, or the lesser of the fair market value of that qualified opportunity fund at that time. So if that fund unfortunately depreciated in value, the gain will be limited to that value. The gain is subject to the tax rates in effect in 2026. So if it's short-term capital gain, it's going to be whatever the ordinary rate is at that time. And there is a second initiative. The second initiative is basically when you roll over capital gain proceeds, either short-term or long-term, you don't have any sort of tax basis. You don't have any value from a tax standpoint in that rollover gain because it has not been taxed, obviously. So the second incentive is if the investor holds an interest in that qualified opportunity fund for at least 5 years, the tax basis is increased by 10%, meaning 10% of that deferred gain is permanently forgiven. And we're going to see through an example how the mechanics work. If the interest is held for an additional 2 more years, so at least 7 years, then there is a 15% of the deferred gain is permanently forgiven. And the third initiative is that if you held that qualified opportunity fund, if that investor held that fund for at least 10 years, any future appreciation in relation to that fund is permanently deferred. Permanently deferred. So let's go through an example. Investor invested in $2 million in 2014 Amazon shares. God, I wish I could go back in time and do such thing myself. The stock is sold in 2019 for $3 million, resulting in a $1 million capital gain. In this circumstance, long-term capital gain. That investor invests $1 million of the gain into a qualified opportunity fund, and as George mentioned earlier, $2 million of those proceeds do not need to be invested in that fund. It can be invested in elsewhere. Now, note that we do not take into consideration the net investment income tax, the NII, the 3.8%, nor do we take into account any state income tax considerations. In 2019, $1 million gain, we're going to defer paying $200,000 of tax, i.e. 20% of that $1 million long-term capital gain. $20,000 in 2014, 5 years later, $20,000, i.e. 10% of that $200,000 tax is permanently forgiven. 2 years later, in 2026, an additional $10,000, i.e. 5% of that $200,000 is permanently forgiven. So after 7 years, 15% of the tax that is due is permanently forgiven. In December 31st, 2026, regardless of the holding period, that taxpayer must pay $178,000 of tax, i.e. 17% of the original $1 million gain that was deferred in 2018, and that tax will be due April 15, 2027. Now, we've got a lot of interest in this, in investing in qualified opportunity fund. And the question, and one of the primary questions that we've got, initial questions that we got is, what is the certification process of creating a qualified opportunity fund? How complex is it? And it's really not that complex. So
this is where I think the Civic Service provider or Treasury provides a good opportunity for the self-certification process, and going through the process, as you indicate on the slide, is fairly simple. Yes.
So basically, it's a self-certification, as you mentioned. There is no approval or additional action that is required by the IRS. So basically, that taxpayer, that qualified opportunity fund, i.e. that partnership or S corporation, merely files Form 8996 and attaches to the tax return. That form must be timely filed and can be filed with extensions. Now, once a entity is a qualified opportunity fund, there is an asset test requirement, and really, that's looking to make sure that the proceeds that are invested into that qualified opportunity fund are fully invested in the qualified opportunity zone. And basically, it's looking to make sure that at least 90% of those assets are invested in a qualified opportunity fund. And that testing is really done every 6 months. If a qualified opportunity fund, i.e. that partnership or S corporation, does fail to meet that 90% standard, there is a non-deductible non-compliance penalty, which is determined every month.
All right, there are some assets which effectively are areas that Treasury precluded from making eligible investments, similar to things we discussed previously, like golf courses or other, not restaurants, bars and other establishments that serve alcohol, and other areas that would be precluded from utilizing as a qualified opportunity zone investment.
Yes, so there are certain types of businesses that are out there in which those businesses could not take that benefit of being a qualified opportunity zone eligible business.
All right, so with qualified opportunity zones, to the extent there are opportunities, pun intended, certainly we recommend to our clients to contact their number one tax advisor for further guidance. With that, let's get into some of the partnership audit regime changes that took place. Well, effectively was signed into law back in 2015, but are effective with this year's tax filing. So with that, let's get into what the changes were, Michael.
Right. So effectively, starting this year, partnerships, as a general rule, no longer file an amended return. And there's been a lot of changes. So the centralized partnership audit regime basically now introduced the concept of a partnership representative, and that's critically important. It fundamentally changes how a partnership is assessed, an assessment from the IRS, and it requires changes to new and existing partnership agreements.
Right. So effectively, a partnership now becomes a taxpayer.
Yes. Right. And as you can see, in each taxable year, the partnership must designate a partner or a person which is a partnership representative. And that partnership representative has the sole authority to act in behalf of the partnership with respect to matters related to the IRS. If the partnership does not designate a partnership representative, the IRS can select any person. And this is critical because the partnership representative has broad authority to bind the partnership in all matters, directly or indirectly, when it comes to arrangements with the IRS. And these could be things in which it does not have the authority under the partnership agreement or under state law.
So we recommended to our clients and sent out correspondence to them to update their operating partnership agreements to effectively incorporate language in those agreements and to carefully look through who the individual or entity or individual underneath the entity will be acting in this capacity. This is something that should not be taken lightly. Conversations should be had, again, with your number one trusted advisor at Sachs LLP. All right, what is a partnership representative? What are the rights and what are the issues that could come up, Michael?
Right, so a partnership representative, basically, since it does have the authority to bind that partnership in terms of any assessment with the IRS, the partners do not have the right to participate in partnership level examination, receive notification of partnership proceedings, challenge the partnership representative's action, or challenge the merits of any adjustment that is pushed out to them by the partnership. We're going to talk about that push out. The partnership agreement should consider, again, notification rights, whether to direct or impose restrictions, actions of partnership representative, and recourse among partners. Right. Again, this is something that needs to be addressed and should have already been addressed and hopefully is being addressed, if not already addressed.
Right. So the options are the partnership pays the tax. Effectively, it's in the regime.
Yeah.
The partnership can push out the underpayment. There's a challenge there. We'll talk about that. And in some cases, certain partnerships will be eligible to be elect out of the new rules.
Right. So these are all elective, depending on certain facts and circumstances. So again, the default rule is the partnership is liable. So the partnership is now assessed an assessment in the tax year, let's say the adjusted year of 2021, for an imputed underpayment adjustment. And again, that amount is really multiplied by the highest tax rate, i.e. 37%. Can be reduced, but we have to bring in facts and circumstances in order to do so. So, i.e., if one of the partners were a C corporation, then you can ask for a reduction to 21% versus 37%.
Or if we have an exempt partner, for example.
Or an exempt partner, that's right. The burden falls in the current year, i.e. the adjusted tax year, so you don't amend. So whenever that adjustment occurs in 2021, that's when you pay. The payment of the imputed underpayment is treated as a non-deductible and non-capitalized expenditure at the partnership level. The partnership's outside bases are adjusted, but not below zero. If the partnership adjustment does not result in an imputed underpayment, meaning i.e. it is a positive result, there is no refund at the partnership level.
Right.
So that is the default rule.
So we get to door number 2. Effectively, we choose to push out this adjustment and make the election to do so. So what happens under that scenario?
So in that scenario, let's say the partnership representative elects to push out the adjustment to the partners in the year that's being reviewed. That burden it must be paid by the review to your partner. So if you had situations in which the year in which the tax burden occurred, so if there's, let's say, for example, 2018, and you had one owner, and in 2021 there is a different owner, that owner in 2021 would be responsible to pay that underpayment, even though it did not benefit from that original underpayment under a taxable income at that year in 2018. Each review to your partner increases or decreases the tax that results from taking into account its share of the adjustments. No amended returns are filed, and the election, again, must be made within 45 days. So, again, that underpayment adjustment is pushed out to the partners. The partners are the ones who pay for it.
Right. All right, so electing out, and then there's another option, and it's only available for limited circumstances.
Right. So it's again, it's only partnerships that have 100 and fewer partners, and if there are any sort of single member LLCs, disregarded entities, or trusts, then that partnership would not be eligible to elect out.
Right. All right, we covered a lot today. I trust everybody has many questions, and they're going to be reaching out to their #1 tax advisor. Some of the questions coming in now. Here's one. Let's see. Do I have to be an active real estate owner or operator in order to obtain a QBI deduction? Michael, what do you think?
I think that is a general yes. You have to be an active real estate owner or operator in terms that it is part of an active trade or business. But again, that's all facts and circumstances.
Right. So here's one. If my interest expense is limited under 163J, how long is the carryover period?
Indefinitely.
Right. All right. Let's see. Here's another one. What is the state impact of a qualified business income deduction? Well, the state impact is, unfortunately, most states, with the exception, I believe, 2, Idaho and South Dakota, with derived taxable income, will not preclude you from taking that tax deduction. All right, let's go to another one. What is the interest expense? Is there interest expense? Is the interest expense being reported on my Schedule K-1 separately, subject to that 163J limitation? Michael?
Yes, that interest would be subject to the 163J limitation at that next tier, which is reporting that interest expense.
Right. Okay, let's see if we have any other ones.
Capital gains related to sales proceeds from a condo development be reinvested into a new fuel fund for a new project. Short-term capital gains related to sales proceeds.
If it's a capital gain, the answer is yes. All right, let's see what other questions we got here. All right, here's one, Michael. Are wages allocated on partnership returns from a common employee eligible for a qualified business income deduction?
Yes.
Right. Let's see what other ones we're getting here. Are there certain businesses which cannot be operated in a qualified opportunity zone? I think we touched on that.
Yeah.
There are accepted businesses, golf courses, massage parlors, training services, restaurants where establishments where the primary sale of alcohol is going to be precluded from making those asset or purchases as eligible for qualified opportunity zone. All right. Here's one, Michael. Can I sell my real property to my brother and then roll over that gain into qualified opportunity fund to defer the gain?
Right. So this is one of the things that we not touch upon in our presentation, but there are related party rules in terms of that deferral of that capital gain. And from this based on this question, it is considered as if you sold that property to yourself, since the brother is related to you, and capital gains from a sale between
Related parties
is not eligible to invest in the qualified opportunity zone.
Here's one. Interesting. Can I invest cash, which is not sourced to a capital gain, in a qualified opportunity fund to obtain the 10-year permanent deferral? I think the question is, I'm using after-tax dollars, Michael.
Yeah.
What do we think?
So, unfortunately, under those circumstances, no. The deferrals that we mentioned for qualified opportunity zone investment are really for capital gain dollars, so pre-tax dollars.
Right. I think that, Margaret, I think we covered all our questions, unless there's any other ones.
Those are the ones we got in.
All right. Certainly, we'd like to thank everybody who attended. I hope you enjoyed our webinar and got some takeaways. Again, if there's any questions, please contact your #1 SACS advisor. Thank you, everyone.